Vietnam's government was one of the first to rush to start trade talks with the Trump administration, but can it avoid steep tariffs? This is Sectors Up Close, and we're talking Vietnam. Officials there are rushing to secure a trade agreement with the US before a 90-day pause on tariffs expires in early July. If there's no deal, it could be faced with a crippling duty of 46%. During the first Trump administration, it was a big winner of the trade conflict between China and the US, as companies rushed to move production there. But now it needs to prove to Washington that its exports really are made in Vietnam and not China. Stephen Schoenfeld is CEO of Market Vector Indexes. Stephen, let's quickly wind it back. Trade tensions between the US and China have been a great advantage to Vietnam in the past, haven't they?
Without question, the number one beneficiary of the shift of Chinese manufacturing or Chinese export to the US. Companies that had plants in China moved them to Vietnam. Chinese companies transshipped through Vietnam. And also Vietnam attracted a lot of Chinese investment. And the exports from Vietnam to the US have grown substantially over the past 5 years.
You mentioned transshipment, that's finished goods made in China being sent to Vietnam for export. The Trump administration is now trying to prevent that using quite a broad definition of the term. How much are countries like Vietnam having to rethink their supply chains? How hard will that be?
It will be challenging. I think Vietnam has moved up the technology and capability curve quite a lot since the beginning of the first Trump administration. So they have the capabilities to manufacture much greater percentage in Vietnam, but they will be under great scrutiny to prove that it's truly made in Vietnam. I think it will take some time, so there could be some short-term pain, but the Vietnamese government is already taking substantial action to help exporters and to help cushion the blows.
Will it be able to prove to the US negotiators that it isn't too close to China?
I think from a strategic standpoint, Vietnam has proven to the US Pentagon and to strategic thinkers that it can be close to the US, including vis-a-vis conflict in the South China Sea. As far as economy, it really will need to attract companies that are dedicated to manufacturing in Vietnam and exporting to the US.
Big manufacturers, according to recent rumour, possibly even Shein, although they haven't confirmed it, might move to Vietnam as a result of tariffs on China. Do you think that they can continue to grow their manufacturing?
It's not clear because the de minimis tax, the elimination of the de minimis tax on customs for small packages like from Shein and Temu is going to hurt them no matter where they export from. I think the real prospect for Vietnam is to continue to move up the manufacturing and technology curve. And it's very important for foreign investors to remember that Vietnam is quite a large economy and it's growing very, very fast. Its domestic demand continues to grow. And so enterprises that serve the growing Vietnamese market but can also export will really be a win-win for Vietnam.
You mentioned, Stephen, that FTSE Russell may be set to upgrade Vietnam to official emerging market status. What does it offer the foreign investor?
So graduation to emerging market asset class for any country means substantial new flows from dedicated emerging market fund managers. Vietnam's regulators, as well as the stock exchange itself, have invested in modernization and reforms. The stock exchange has brought on, early in May, the KRX system from Korea. And the treatment of foreign investors, while still not exactly equal to local investors, is improving markedly. We believe at Market Vector this will enable it to graduate into our emerging market asset class by the end of the summer, and it is widely expected that FTSE will graduate it in the fall.
Do you need a very strong appetite for risk, though, Stephen, to invest in any emerging market focused on exports to the US right now?
You do, but emerging markets often reward risk with higher returns. And Vietnam, in my opinion, adds the benefit of a very robust domestic economy with very positive demographics. Its population is young. It's doubled since the end of the Vietnam War, and domestic consumption is growing at around 20% a year.
That was Stephen Schoenfeld of Market Vector Indexes. Don't forget, you can watch more videos on Reuters.com.